If you take a look at the bottom 6 companies on this list, you will find companies that are loved by investors and traders here in the UK. Companies that are household names, companies that have very high volumes traded on a daily basis. If you take a look on the flip side at the top 6 companies on this list, you'll find far less popular stocks. Great companies, but companies that most investors or traders either haven't heard of or haven't even thought of looking into as a potential long-term investment. Today we're going to take a look at a company that would, based on this, end up at the bottom of the table. They're a very popular stock, very popular with UK investors, but will they find themselves at the bottom of this leaderboard or at the top? Hey there guys, how's it going? Welcome to the FTSE Show, episode number 19. With me, Chris Chillingworth. Hope you are doing well during this whole lockdown process, which we have never seen before here in the UK. Very odd times, but a very awesome opportunity for long-term investors, people that are looking to buy and hold companies for the next 5, 10, 20 years. Because we've got some decent cheap prices out there right now, and these are prices that weren't available to us in January, and I'm very excited about the opportunities coming up. Appreciate that it's very difficult for some people in terms of people being put on 80% salaries, other people not being able to earn anything at all. Very worrying times for people, but for those that are in a position to be able to continue to invest or at least start investing, now is a fantastic opportunity for you. Today we're going to take a look at a company called Rolls Royce Holdings PLC, I think it's listed as. But Rolls Royce, very well-known company here in the UK, a classic British business that many British investors will hold a candle to, and will be a company that many beginner investors might even look to invest in as one of their first investments. 14.4 million, I think it is, shares traded a day on average, so a very popular company amongst investors and traders. However, over the last year, share price has dropped 72%, and it's a very similar figure over the last 5 years. So this is not a company whose share price has done particularly well over the last 5 years. We're going to take a look at the numbers. Listen, if you, like many people in this country, enjoy car crash TV, I think that's what you're about to see. Okay guys, so Rolls Royce Holdings PLC, we're going to take a look at these financials. Epic code is RR. Index is the FTSE 100, and they are in the aerospace and defence sector. So first thing that jumps out to me at the moment is the revenue has been going up. As you can see here, we've got some steady, consistent growth over the last 12 years, 2008 to 2019 annual reports. And yeah, that looks like a really good start. Okay, first of all, that's a good place to go. Unfortunately, that is the best of what we're going to see with Rolls Royce, because the rest of it is downhill from here. So, sorry if you're a shareholder of Rolls Royce right now. If you're thinking about getting into Rolls Royce, make sure you watch the rest of this video before you make that call, because I've got some real concerns over this company, unfortunately. Cost of sales is rising at a far faster rate than the rise in revenue. Now, hasn't been doing so up until 2015, 2016, where we've been typically seeing sort of 20 to 24% gross margin. This is the slice of the pie that Rolls-Royce get to keep of the revenue after cost of sales has been deducted. The last 3 years has been on a decline, and you could argue the last 5 years, because we've seen 23.9 down to 20.4, 16.4, 7.6, and now in the last year 5.7%. That is the slice of the pie that they're getting to keep of the revenue, and we still haven't deducted expenses, R&D, interest on debt, taxes, all of this, right? So we're starting off 2019 with what's looking like it's going to be a poor year. And you can see underneath we've got a load of red as well. So this isn't going to be good. It's not going to be pretty. But yeah, starting off, it's the cost of sales. Cost of sales is causing Rolls-Royce a massive problem here, because it's taking up a big chunk of their gross profit. Expenses looks bad. The last couple of years, they were doing fine at sort of 38 to 40% a year on the expenses, which is a relatively healthy rate, not one that would scare me away at all. But in the last few years, obviously, we can see these percentages have jumped up. Now, this isn't because as such the expenses have been rising. It's because the expenses have been staying the same whilst the gross profit has been falling. The gross profit's fallen from 3 billion to 2.4 billion to 1.2 billion down to under a billion, down to 942 million. Whereas because the expenses have stayed the same, therefore the slice of the cost, the value of the cost of expenses against the gross profit, it outweighs it. As you can see, last year where they made 492 million in gross profit, well, their expenses were 1.1 billion. And they've been like that for a long time. In fact, the year before they were up at high as 1.6 billion. But 1.1 billion in 2019, well, that's it. There goes the profit. There goes any chance of any profit already, and we've still got all of this income statement left to go through. So, not cool. Not good. And then we can go to R&D, and again, similar sort of story. R&D levels, the amount that they were pumping into R&D of the gross profit was at a healthy level. They're sitting about 20%. I mean, it's high, but we'd expect it to be high for a company in the aerospace and defence sector, a company like Rolls Royce. They're going to need to spend money on R&D, but it is a little high, and I tend to personally shy away from companies that need to spend a lot of their revenue and shareholder equity and profit on R&D to stay competitive. So there's probably, even if the numbers were looking way better, I probably wouldn't be interested in Rolls Royce, but I'm definitely not interested in Rolls Royce now. As you can see, the last 4 years, again, it's not that R&D isn't necessarily massively shot up in terms of the cost. In fact, it's gone down over the last 4 years. You can see from 918 million to 843, 768 and 770. That's million. The problem is that the gross profits have been dramatically falling, and the cost of R&D, or the money they've been pumping into R&D, hasn't fallen anywhere near enough to keep up. And so now R&D costs them 81.7% of their gross profit, whilst expenses are costing 119.7% of their gross profit. You don't have to be a mathematical genius to work out that's not going to end well. Let's take a look at interest on debt. I mean, again, far too high, and it's going to cost them big time. Let's not dwell on that, but we're talking about 2016 spending 4.6 billion on interest on debt, 2018 2.1 billion on interest on debt. That's huge. So I'm going to be expecting the debt levels of this company to be pretty high, which that's the last thing they need. If this is the income statement and the performance of this business, if they're going to have high debts, they've got real problems. We've omitted the gain or loss on sale of assets. So they've been selling a lot of assets off over the last 10, 12 years. We've omitted the sale of those assets because you can't rely on them. They're not part of the recurring everyday business. So we extract those incomes, and rightly so, because they're extraneous sales, not part of the everyday recurring business of Rolls Royce PLC. If they sold off an arm of their business, well, they're not going to have that again next year to be able to sell off. So you can't rely on it. And when we're trying to judge the performance of a company, we want to judge the performance of the recurring everyday revenue business. So that's all been omitted. And then we come down to the true net earnings. What's the recurring revenue of the business actually achieving? What kind of profits are they actually getting from the recurring everyday business that they run? And as you can see, over the last 6 years, only 1 year has been profitable. The other 5 they've lost money. In 2014, they lost nearly 200 million. The next year, they were down 28 million. Then in 2016, they lost 4.1 billion. Next year, they made 2.5 billion in profit, but then lost it and more the following year, 2.7 billion down. And then in 2019, they lost 1.5 billion. Not the numbers that I would want in a company that I'm hoping to see share price growth in over the next 5, 10, 20 years. In fact, it's kind of the polar opposite of what I'm looking for. I'm not looking for a company that even has one losing year. One losing year puts me off. So to have 5 out of the last 6 spells to me there are problems at this company, for sure. We're going to the balance sheet. What I'm interested in looking at more than anything is really, we've got 4.4 billion in cash, so that's important. And they've got 5 million in net receivables, money that's owed to them by other people. They've got 4.8 billion in property, plant and equipment, 5.4 in intangible assets, but those are not liquid, so therefore that's going to be difficult for them to turn into cash in a pinch if they needed to. So you can't really rely on that too much. Debts is what I want to look at. 775 million in short-term debt and let's call it 5 billion in debt long-term. The problem or the concern I have here is a business that's making a financial loss 6 years out of the last 5 years out of the last 6. In fact, if we add all of these years together in terms of the profit and loss or the earnings that they achieved, they will be down 2.3 billion. So they've lost their shareholders 2.3 billion over the last 12 years. So they're going to struggle then, in theory, surely, to pay off that debt of nearly 5 billion and then 775 million. It's thrown out all my figures and all my formulas, because what this essentially does is usually works out for me, okay, how much is the debt that's owed? And based on the earnings power of this business, how long would it take them to pay that off? Well, there is no earnings power at Rolls Royce. They've been making a loss the last 5 years out of 6. So, yeah, that's going to be a problem to pay that off, I would imagine. I'm not an expert on that, but the numbers don't bode well, as far as I can see. And then, very rarely do I see a company with a negative equity, as in they have more liabilities than they have assets. I don't see that very often, and it's only been in the last couple of years at Rolls Royce that has been the case, because they were doing very well in that respect up until 2013, 2014, and it's all been very much downhill since 2014 onwards, and to the point where they're in a negative equity of 3.3 billion. Essentially, they have more liabilities than they have assets by the value, by the tune, if you will, of 3.3 billion. So that's not cool. And then lastly, the last place I'm going to go before I go away and have a little cry. I don't own any shares in Rolls Royce, by the way, so just, I'm just crying on behalf of them. Their retained earnings are at minus 5.1 billion. If you're not sure what retained earnings are, essentially this is a pot of money that that accumulates. They pump money of the profits that they make for the shareholders. They can pay that off in dividends, of course, and reward investors for being shareholders, and try to attract new shareholders. They can spend some of that money, that profit, on buying more assets for the business to hopefully improve income. They can buy back their own shares to reduce the number that are in circulation and therefore help drive up share price because it raises demand. Or they can pump it into a pot, and that pot can accumulate, and they can use that to acquire other businesses. They can use it as a rainy day fund. They can use it for all sorts of stuff. Their pot sits at minus 5.1 billion. And again, it's only been a recent development that has been the case. Only the last couple of years we've seen that dramatically fall off. And these numbers are not looking good. They got high capital expenditure costs as well. I don't like this whatsoever. Let's take a look at the chart. Okay, so this is the roller coaster ride of Rolls Royce over the last 12 years. As you can see, back in 2008, when we first started doing the analysis, they're trading at a price of about £4.40 a share, roughly speaking. Their share price was sitting at about £6.50 a share. So, if you'd held them over that period of time, you'd be up a couple of quid maybe per share. Certainly not a great investment. It's been up to highs of nearly 13. In fact, it's very close to hitting £13 a share at its height in 2014. Remember, 2014 onwards was the year that the financials started to look really poor. And as we can see, we've basically seen a drop-off since then. We saw a resurgence from 2016 to, let's say, 2018. And then again, since then, it started to peter off. Now we have the impact of 2020's stock market crash that isn't necessarily a reflection of Rolls Royce, but more of a reaction
by shareholders and investors into the fear of what's going on. But Rolls Royce have not benefited from this at all. Now, I've been hearing some commentary in Facebook groups and reading some posts from people in Facebook's various investing Facebook groups that I'm in, saying, are Rolls Royce a steal now at £3 a share? It's actually £2.97 a share. Here's my take on this. No. This is not a company I would even remotely be interested in investing in. You know, if I'm looking for a company that's going to grow in share price over the next 10, 20 years, I want a company that's going to grow well. I want a company that I can buy at £3 a share and it's going to be £30 a share by the time, 20 years down the line. Rolls Royce are not going to be that sort of company. Rolls Royce have got some serious financial issues, and the numbers are not looking strong, and I think that they're in trouble. I think there's an element of trouble there for Rolls Royce. Now, I'm not one for speculation, but the financials don't look good, and I'm staying well away from a company like this. Yes, the share price might be attractive at £3 a share, and you have to make your own decision as to whether or not you feel that it's a good investment. From my point of view and where my money goes, it's not going anywhere near Rolls Royce. I'm not interested at all, and I'm going to be putting my money in all of the different options that are out there that do tick all my boxes, that do look attractive. Why take the risk of pumping your money into a company like Rolls Royce just because of the brand name, just because you've heard of this business, just because they're a British company? There are other great, far better performing companies out there than Rolls Royce, and I would rather put my money into them than this company. So let's go over to the leaderboard and see just how badly Rolls Royce have done.
Okay, so possibly one of the worst companies that I've seen in terms of a financial aspect. That's essentially what I'm looking at. I'm just looking at the facts. I don't necessarily know all the stories behind the numbers, but the numbers tell us what's factually going on with these companies, and clearly Rolls-Royce not doing particularly well out there. And I wonder for their future. I don't know. I mean, who's to say? I'm not really much of a speculator in that instance, but the numbers are not looking good, right? And there's some concerns there. I, for one, definitely not looking at investing in this particular company. They are way down on my list of companies to look at. So let's get them on the leaderboard. I think it's going to be grim reading. Let's take a look. Okay. Right. Red pen time. Let's hope this still works, because I think it's been a little while. No, Centrica are probably the most recent failing company on this list. Okay, so we knew this was going to be the case, didn't we? Right. Okay, so these guys have set a new record. This is the bonus here is that I'm not going to have to move all these prices down, because Rolls-Royce unfortunately scored a rather appalling but expected, having looked at those numbers, score of minus 103 points. A record on this show for the wrong reasons. But I think that's apt, I mean, I put these companies through exactly the same process as each other. I score them in exactly the same way using my algorithm, my measure that measures the right behaviours and the right numbers and the right facts, and the right results, financial results. And and it's measured and weighted based on what I'm looking for growth stocks. So generally speaking, when a company fails this badly, they're not a good pick as a growth stock. Let's get them up on the board. Okay, so you'll notice we've had to go to a second column now. Rolls-Royce are our first company there. That is now the bottom of the table, essentially. Not a company that I would particularly recommend to anybody. You've got to do your own research, but maybe stay clear of this one. Cheers, guys.